Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, also known as Mr. Valuation. It's my pleasure to welcome you to another Subscriber Request Tuesday video. With this week's video, I'm going to cover the energy sector. It's kind of ironically the lethargic energy sector. You might even say the energy sector is running out of energy. I've been reluctant to cover this sector because of what I just said. I do see a lot of problems. I do see an industry that's in a major transformation. We have this move to renewables, electric vehicles, and so on and so forth. So the energy sector, especially in the U.S., but even actually worldwide, has really been under a lot of duress lately. So I'm going to go ahead and look over the sector. And as I do that, I do want you to notice a couple of things as I go through this video. Number one, you're going to see a lot of similarity worldwide, not just in the U.S., but worldwide, about how businesses have been able to perform operating in the oil and integrated oil and gas sector, which is the primary sector I'll be covering. So let's go ahead and get into the video. I've created a portfolio review here for you. I'm using my FastGraphs tool, and what I've got here are some of the most preeminent, what we'll call integrated oil and gas companies in the world. And I want you to notice I've got two here from the United Kingdom. I'm going to put them in order here. I've got two from Canada, two from China, one from France, two from the Russian Federation, one from Spain, two from the United Kingdom, and then three from the United States. Okay, and these are some of the premier, again, integrated oil and gas companies in the country. I'm going to go through these by looking at what's been happening to their operating results, and I'm going to talk a little bit about their dividends, because as you look at this, at this review I've done here, you'll see the dividend yields range from virtually nothing on Occidental Petroleum. It is the only really below investment grade stock in this issue, but I did want to point it out because it's obviously a well-known company. But you'll see the yields run from, the real yields from about 2.39% up to 5.39%. So they are intriguing from their dividend yield. But I think we got to look beyond that, and I'm going to try to do that for you very quickly in the video. I'm going to cover these companies very superficially. I'm going to cover them very, very quickly, because what I really want to get the message across is that what's happening throughout this sector is happening really throughout this industry, is happening throughout the industry worldwide. Okay, so here we've got, United Kingdom, the old British Petroleum, now known as BP. And what I want you to note is these companies did pretty well coming into the Great Recession. But then since the Great Recession, and since we've really had this major push on, climate change and the movement to renewable energy sources, et cetera, I want you to note that the energy sector stocks have really struggled to generate any revenue. Now, this is an ADR. I do want to make that clear. It's an American depository receipt, and the company, so there's some translation here, there's some currency conversion, et cetera. But nevertheless, you can see the company's really had very poor operating results. Earnings have really not grown at all since the Great Recession. In fact, it's had negative 2.12% growth. Now, it does offer a very attractive 4.79% dividend yield, and the earnings yield is only 2.4%. But the company, COVID, of course, hit this industry really hard with all the shutdowns, oil and gas. People weren't driving, they weren't doing any of the traveling they normally do. So we are expecting to see a recovery. So from that point of view, the future earnings yields could actually be very attractive if you're looking at what earnings are expected to recover to in the forthcoming years. So you might want to take that into consideration as you look at these stocks. You kind of have to overlook the COVID position. But nevertheless, the companies have really struggled to make any money. Now, from a dividend perspective, and this is very, very important as I go through these companies, from a dividend perspective, most of these companies are covering their dividends with operating cash flow very nicely. Free cash flow is a little bit different matter. But again, I'm not going to go into great detail on any of these. I also want to just take a quick look at price to sales and let you notice that sales have also been rather weak, since the Great Recession. That's the burgundy shaded area here that I'm showing you here. But anyway, there's British Petroleum. The next company I'm going to go to is Chevron, which is obviously one of the major U.S. companies on the planet. And again, you're going to see a very similar picture here than what we saw with BP. Very erratic. This is operating cash flow. It does cover the dividend. Chevron does have a very good dividend record. I've been long this stock for a long time, but you can really see the price performance has really struggled during this time, averaging about 4.5% over this long period of time. But if I shorten that, to a 15-year graph, it's only 2.8% during a time when the S&P grew by 13.5%. These companies are really struggling to make any money. And once again, if I quickly look at sales have been dropping for, the companies in this sector quite a bit. So let's move on. Let's go on. I'm going to stick with cash flow here for you because one of the intriguing parts of this particular sector is the dividend. Here's Imperial Oil. Their operating cash flows are covering the dividend except for the COVID year, which again, I think you have to give them a pass on that. But once again, you see almost nothing going on in stock price, but you see a good dividend record. Dividend growth has averaged almost 17%, a 12.6% compound average since 2001. It's been, extremely consistent, if you will. It's actually produced more income than the market, and it actually has a decent track record over that period of time. But once again, if I shorten the time frame here and look at it from a shorter period of time, you can see that, the return has actually been negative, since 2009, since coming out of the Great Recession. The capital appreciation has been negative. It did pay a little bit of dividend income, but anyway, it's the nature of the beast. The whole industry is going through this kind of stuff, but they are covering their dividend. The next company I want to show you is Lukoil, which is a Russian Federation company. Again, they're generating good cash flows, a little bit of a dividend, erratic record, but again, pricing you can see has gone from $54 a share in 2009 to, $88 a share today. If I look at long-term performance, I've got a pretty good dividend record, but in fact, an excellent dividend record, I might say. And I've also got a good capital appreciation record if I'm going all the way back to 2021. However, if I shorten that time frame to just, post the Great Recession, the numbers, I underperformed the market on capital appreciation, but outproduce it on dividend income. But again, now this is a Russian company. The next one I'm going to look at is Gazprom, which is another Russian Federation company. Again, very strong cash flows, but I do want to point out sales growth has been really non-existent. The growth of sales have actually been falling since the Great Recession for the most part. So again, these companies are finding it very, very difficult to make any money. A pretty erratic dividend record, but this is an ADR and it's got currency conversions. And, each ADR here, I think, represents a half a share or something like that. So it's not, the actual public company. But anyway, this is Gazprom, which is another Russian company. The next one I want to show is Occidental Petroleum. When you look at Occidental Petroleum, it is the one that has the below investment grade credit rating. It does have a lot of debt on the balance sheet. Dividends have disappeared here. And, forecasts for operating cash flow look decent. But if I take this back to operating earnings, the analysts that follow this company expect a lot of weakness in the earnings. They actually expect negative earnings growth over the next several years. And I checked that also against Yahoo estimates. And I also got negative expectations of earnings growth over the next 5 years in Yahoo. So for whatever reason, I don't really know the reason. I haven't really researched this company deeply. But once again, we see this very, very poor operating history since coming out of the Great Recession. And once again, we see weak sales growth. Sales have been recovering a little bit, in 2018, 19, and 20 before we hit COVID, until we hit COVID. And then, of course, we all know what happened, during the COVID pandemic. The next one I want to look at, again, I'm just going through these very quickly just to give you an overview and let you see that all these companies are struggling to make any money. None of them have generated stellar earnings. Here we've got PetroChina, which is obviously a Chinese company. The performance has been horrific. If I shorten this to a 15-year graph, you can see that the company has actually had a negative capital appreciation. Did pay a little bit of dividend, but it's been a very poor investment because their operating results have been poor throughout this period, just like the rest of the industry. They've all suffered under the same operating history, this movement to renewables, et cetera. Royal Dutch Shell, another United Kingdom company. Again, we're seeing the same issue, elimination or rate reduction in the dividend. Moving on to another part of the world here, we'll take a look at Spain. And once again, we see just very, very poor operating results since coming out of the Great Recession. They're not identical, but they're almost identical if you get my drift. They're all struggling to make any money and generate any earnings, and their dividend records also show that on the most part for a lot of these companies. So, I just want you to recognize this is a very, very tough industry. Here's China Petroleum and Chemical. It's an A+ rated company with low debt. It does offer a nice dividend yield, but once again, the dividend has been very erratic, as been the earnings. Very, very difficult for these companies to make any money. So I do want to just keep pointing that out. That's why I haven't shown this industry and why I've been reluctant to show it. This is Suncor. Again, here I've got real issues with operating earnings. This is a Canadian company. We see a cut in the dividend, almost the elimination of profits during COVID. And, from a standpoint of operating cash flow, which is critical when you're examining these dividend-paying companies, in my opinion, I am seeing the operating cash flow covering the dividend. But, of course, COVID again, I think we give all these companies a pass for that. Moving on, let's look at Total Petroleum. Total Energy Services, I guess it goes by. Operating cash flow covering a dividend, but it's got kind of a very spotty dividend record. From a standpoint of operating earnings, the company's having exactly the same issue that every other company I've shown you in this sector has had. They've had a great deal of trouble making money. If I look at price to sales here, their sales have been increasing rather dramatically. That's something you might want to look into. But again, I just don't see a whole lot of investment merit in any of these companies. And the last but not least is the mighty Exxon. Exxon used to join Microsoft and Johnson & Johnson as one of the few AAA rated companies in the world. That was during a time when they were growing and their business was doing well. But since that time, they've struggled, as you can see. Again, the same old story here. Earnings have been falling. Sales have been very, very hard to come by. However, their dividend record has been exemplary here. And if I look at the company through the lens of operating cash flow, and whether or not their dividend is covered, they have been covering their dividend quite nicely with operating cash flow. They've generated a lot of dividend income relative to the other stock, but again, they can't generate any capital appreciation simply because, the company can't grow their business. They've been struggling like every other company in the integrated oil and gas sector to grow their business. Anyway, I hope you've enjoyed this video. I will leave you with, I started out with British Petroleum. They do a statistical review of world energy every year, and this is the 2021. This is their actual report. I'm going to put a link to this at the end of the graph because there's a lot of information here about energy. If you're interested in looking further, you can see maybe why some of these companies have struggling by just going through this very excellent report. They're talking about, what the market share. They're talking about energy consumption, how it's changed since the 40s. We're talking about CO2 emissions have also followed suit. We're talking about demand versus predicted here. They also get quite a bit into, and of course, this is the problem with what I've shown you with all these graphs here, but you're going to see the sources for wind, solar, and geothermal, and what countries and what parts of the world are participating in that the most. And, there's a lot of information here if you want to learn more about the energy and gas sector. It's been Chuck Carnevale saying thanks for watching. Hope you enjoyed this video. This has been a subscriber request Tuesday series on the energy sector, a sector that is, frankly, has a lot of lack of energy right now, pun intended. Thanks for watching. Give me a like, ring the bell, and I'll talk to you real soon. This has been Chuck Carnevale saying thank you.